Good morning and welcome to the Killik podcast for Friday the 6th of November. This week we've had updates from the Bank of England and the Federal Reserve. The Bank of England have said they're going to keep rates on hold, 8-1, and the rate is currently around the right level to achieve a 2% inflation target within their forecast period. The Federal Reserve have been priming the market for a rate rise in December, saying it's a live possibility. So you've had sort of moves in the UK Treasury market. So the yield on the 2-year Treasury fell during that meeting, and you've also seen sterling weaken against the dollar, which is pretty important for our portfolios. Here you can see that because of the divergence in views of when rates are going to rise. So here you've got that in a chart. So you've got the increasing spread between the probability of a rate rise in the US against the probability of a rate rise in the UK in December. And you can see that's quite a big move in terms of that spread widening. And that's why the currency has moved to reflect that. So where we are in the market in terms of the US with this growing sense that we'll get the rate rise in December is the market's been rallying. So the market, in our view, likes the certainty of the Fed being able to plot the path that they see as correct for the longer term health of the economy. And they also like the fact that they're getting more confident on domestic growth and less worried about international growth. So as we can see here, the PE of the market historically expands as the nominal Treasury yield rises. So that's just saying as rates go up, because the central bank is more concerned about growth coming through, the market gets more positive about the top line growth for companies, and therefore they're willing to ascribe a higher price to earnings ratio to reflect that higher top line growth. So here you can see if you've got nominal yields around 5 to 6%, the US market has traded sort of around 23 times PE, quite a material premium to where we are at the moment. In terms of the latest industry data, we have seen a heightened divergence between manufacturing and services. One would expect that because the manufacturing data captures all the issues that we're having with the commodity complex. But here we haven't really seen that divergence for a long time. This series of charts on the US ISM, which is the Institute of Supply Managers, this is their survey data, showing a fairly close correlation between manufacturing and services since this chart started in 2006. But here you've seen quite a big divergence. So that's really coming through in company forecasts. And here, looking at the FTSE, you've got earnings estimates for the FTSE All Share against the FTSE Oil and Gas sector. And as you can see here, the oil and gas sector has been on a sort of, after a very rapid decline pre this chart, you've seen a sort of gradual sort of fall of that earnings estimates as analysts got their heads around the impact of oil at a significantly lower level. But they haven't implied the second round effects of a retrenchment in oil and mining companies in terms of where they're spending their money, in terms of CapEx, what service companies they're using to sort of deal with things like their employment and workforce. And now they're really just starting to downgrade those numbers to reflect that. So you've seen a faster rate of downgrade in terms of the all-share earnings numbers than you've actually seen against the oil and gas. So we're always worried about the delta, the movement in the change. So that's quite an interesting chart to be keeping an eye on. And therefore, as we go into the Q3s, we've been really sort of trying to insulate our portfolios against those second round effects, those sort of effects that you don't really think of first off when you're thinking about the oil price or commodity prices falling. And this week we've seen Compass, we've seen Meggitt, we've seen AMEC all disappoint because they support that oil and gas and mining sector, even though they're not directly exposed to the commodities, and therefore you just got to be alive to that. Next week, on that subject, we've got Rolls-Royce reporting And at the moment, the market is expecting somewhere between 55 and 62p of earnings for this year. And we think that we'd be very happy if they actually made that guidance, because we've seen weak numbers in their core markets of power systems and marine. And there's some concerns over civil margins, and particularly the investigation that is now going on into the margins that they're receiving on their after-sales business, which is part of the business that we really like. So the stock's currently at a 20% premium to the sector. So they really do need to make their numbers. So we're watching that pretty carefully going into next week. Other stocks reporting next week. On Monday, we've got our new recommendation, Continental. On Tuesday, we've got Vodafone, Land Securities, National Grid, Wolsey, Pru, UBM. On Wednesday, ICAP and eShore. This morning, ICAP have announced a possible deal with Tullet buying a significant part of their business, which has been very well received for the shares of ICAP. Then we've got Royce, which we talked about on Thursday. And on Friday, we've got no reported stocks for Killik, but we've got the LSE reporting. So that's it from me. Thanks for listening. Have a good weekend.